Hello friends, my name is Deepesh. Today we are going to review ABSLI Fixed Maturity Plan. ABSLI stands for Aditya Birla Sun Life Insurance. We'll review the critical features and see if you should invest in such a plan. Now, just by looking at the name, you would have thought that this product has or is very similar to a bank fixed deposit. And why not? We have fondness for bank fixed deposits. Almost two-thirds of Indian household wealth is in bank fixed deposits. So it's only natural for an insurance company to launch products that give you that look and feel of a bank FD. So we'll see how this plan is similar to a bank FD. It's very similar nomenclature. There is fixed in the name. So even though it cannot use fixed deposit, it has used fixed maturity. It's a single premium, very much like a bank FD in which you make deposit once and then you get your amount back along with interest at the end of the maturity period. The returns are guaranteed. There is no confusion. You know how much you will get at the end of maturity. It's a single payout, no interim payouts. You invest once, and then at the time policy maturity, which typically is from 5 to 10 years, you'll get the amount in one lump sum. Not very long maturity. Similar nomenclature: single premium, one-time investment, guaranteed returns, very easy calculation maturity amount. You just have to simplify your multiply your investment amount with a single percentage and you get your final maturity amount that you will get. And not very long maturity, 5 to 10 years. Usually you see insurance products that have maturity ranging from 25-30 years, 20-30 years, but not so much the case in this plan. Only limited maturity. You can choose a maturity between 5 to 10 years. It's a non-participating plan, and it has to be the case if the returns are guaranteed. We have to look at a non-participating plan. Again, just a recap: traditional plans can come in two variants: non-participating or participating. In participating plans, you participate in the benefit in the profits of the company, and since profits are not known upfront, you do not know how much you will get. You will get bonuses, but those bonuses are not guaranteed. In non-participating plans, which is the case with this plan, this is a non-participating plan. You don't participate in the profits of the company. That's why you can figure out upfront how much you will get and when. So returns are guaranteed. You can use any spreadsheet software like Microsoft Excel to calculate your IRR. And again, it's the responsibility of the insurer to pay you the promised amounts. They can't go back and say, okay, we have not done well, we won't pay you. That's not an option. You get what you have been promised upfront, unless of course the insurer defaults. That I think is a very low probability. So there's a single premium plan. You pay premium just once. Two variants, option A and option B. The difference between those two variants is primarily in terms of the coverage amount. So you can see in option A, your life coverage is between 1.25 to 1.77 times. In option B, life coverage is between 10 to 10.42 times. And that plays a very critical role in how the maturity proceeds from these plans are taxed. Usually we associate that the proceeds from life insurance plans will always be taxable. Yeah, fair enough, but that's not always the case. The maturity proceeds are exempt from tax only when the the life cover is at least 10 times the annual or single premium. If that's not the case, the maturity proceeds will be taxable. So in option A, since this condition is not met, the returns will be taxable. In option A, B, returns will not be taxable. How much you will get? Very easy to calculate. There are certain premium bands. So right now I'm talking about option A. There are certain premium bands. You can just look at the policy maturity: 5, 6, 7, 8, 9, or 10 years, and accordingly you can calculate your maturity amount. So let's say you are in band 6. Band 6 essentially annual single premium of 5 lakhs or above. So if you are in band 6 and if you buy the cover for 10 years, you will get 184.7% of your investment amount back. So if you invest 10 lakhs, you will get 18.47 lakhs back. The returns in option A do not depend on age. We'll see in option B that's not the case. Returns will depend on your age. So again, option A, let's say you're 45 years old, you pay 10 lakhs, including GST, premium will be 10.18 lakhs. Maturity is 5 years. Since you are paying more than 10 lakhs, 5 lakhs, you will fall in band 6. On completion of 5 years, you will get 134.9%. So you can see it easily. So band 6, 5 years you get 134.9%. So you get 13.49 lakhs back, that which is an IRR of 6.17%. Everything else being same, had the policy maturity been 10 years, you would have got 18.47 lakhs back, which is an IRR of 6.33%. Remember that option A returns are taxable. So let's say you bought plan for 5 years, 13.49 lakhs is the majority amount, you had invested 10 lakhs. On the return of 3.49 lakhs, you'll have to pay tax as per your slab rate. So that will affect your returns. In option A, slightly complicated. In this case, the returns also depend on your entry age, which should happen in case of insurance plans. See that this should have happened in case of option A also, but in option A, the life cover was very small. Uh, so uh, so your entry age did not affect the returns. But in option B, since the life cover is a big multiple of a single premium, the entry age also affects the returns. So you can see as the with the entry age, your returns go down, and that's expected. Some portion of your premium goes towards providing you the life cover. So of course, for younger investors, that cost for providing life insurance is low, and since the cost is low, returns are high. For older investors, the cost of providing insurance is high, and that eats into the returns. So you can see for any band, for any policy maturity, you will see as the as the policy as the entry age goes up, your returns go down. You can see at the end of 5 years, completion of 5 years, if you invest the same 10 lakhs that you invested, you will get an IRR of 4.82%. You will get 12.65 lakhs back, IRR for 4.82%. If you change the policy term to 10 years, you will get an IRR of 5.35%. 16.83 lakhs essentially on completion of 10 years, and the IRR of 5.35%. With option B, the benefit is that your returns are tax free. One thing that you must keep in mind, option A will offer you better returns than option B. Simple reason, option A does not provide you, so everything else being same, age is same, your investment amount is same, your policy maturity is same. Option A will offer you better returns than option B. Simple reason being, simple reason being, option A has very low life cover, 1.25x single premium. Option B has a much higher life cover. So higher life cover, higher insurance cost, lower returns. In option A, so option A offers you higher returns, but those returns are taxable. Option B gives you low returns, but those returns are tax free. So we did see that option A was offering you returns of somewhere in the range of 6.17 to 6.33%, but option B was offering returns only to the extent of 4.82 to 5.35%. So low returns in option B, but tax returns. In option B, your entry age will also affect your returns. We have seen this. We also saw this in the charts here. As the entry age goes up, your returns go down. So let's say your premium is more than 5 lakhs, you will fall in band 6. If your age is between 8 to 35 years, you will get 172% of your investment amount back. If your age is between 46 to 50 years, you will get only 157% of the investment. Again, the reason is the same. The entry age is higher, the returns will be lower. So what you don't want is that you look at the let's say you're 45 years old, you look at the brochure for 25 years old, right? And you like the returns and you sign up for it. That should not happen. So you must check the returns for your age. The returns will go down. So I've shown returns for 45-year-old, uh, but if the same policy was bought for 35-year-old, returns will go up from 4.82 to 5.4% for 5-year policy term, and 5.35 to 5.59% for the 10-year policy term. Premature exit is costly, and that's usually the case with traditional life insurance plans. So I've just kind of considered an example. If for a 45-year-old, you make an investment of 10 lakhs and you decide to return the policy after a few days, of course after the end of free look period, you'll get only about 6.62 lakhs back, which is a big hit. You invest 10 lakhs, you get only 6.6 lakhs back. So if you're buying this product, you be sure that you will stay in this product for the until maturity. Otherwise, you will have to take a big hit, especially on exits which are closer to investment dates. Um, Again, what should you do? Should you invest? ABSLI fixed maturity gives you look and feel of a bank FD. No doubt about that. Guaranteed returns, one-time investment, long, not very long maturity, and it's a very simple. It has a very simple structure. I've seen many non-participating plans earlier, but the calculation of the maturity amount is not very easy. It's quite complicated. You need to really look at the policy wordings, policy charts, how this works and that works, before you really figure out how much you will get. But in this case, you just have to multiply your investment amount with a single percentage, and you know how much you will get. So on those fronts, this product scores perhaps over other non-participating products. Um, but the problem is that the returns are not really impressive. In option A, where the proceeds are taxable, you earn somewhere around 6%. In option B, where even though the maturity proceeds are tax free, you earn only about 5%, 5 to 4.75 to 5.5%. Now, that's not really a very good return. So, in my opinion, you must let this pass. The premature exit is also very difficult. If you want to, as we saw, it, there's no easy way to exit. If you want to exit prematurely, you'll have to pay a significant penalty. So, in my opinion, you should give this product a pass. But yes, for any reason, if you find merit in this product, do consider the implications of tax implications of option A and B and choose between the two variants accordingly. It's easy to ignore that returns from option A will be taxable. So again, a thumbs down to this product from my side. Please don't invest. Yeah, and thanks for watching the video.